Okay, what is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be talking about how to get started investing in the stock market and why you need to be investing. So, just for some background information, I am 26 years old. I started investing when I was 17, so this will be 9 years that I've been investing. I've learned a lot of stuff over those years, and I've made a lot of money over those years. And there's an easy way to do this and a hard way to do this. There's a risky way to do this, and there is a safe way to do this. Now, most people are scared to invest because they don't know what they're doing, or they think it's like a scam, or they think it's risky, or you're going to lose money, all these different things. I can tell you that you look at all the different ways to grow your money. You look at people who, you know, are wealthy. Pretty much all of them are going to be invested into the stock market. Okay, like there's only a couple different ways that you're going to grow your wealth. It's going to be through having a business, investing in stocks, investing in real estate, or something like that. There's not a whole lot of options, and you can go the route of investing in real estate or something, but for me it just makes a whole lot more sense to invest in the stock market. I think the returns are way better, and I think it's way easier, it's way less work. You don't have to go get a loan. You can hit a couple buttons on your computer, and next thing you know, every year you're making more and more money. So the first thing I want to talk about is an index fund. An index fund like the QQQ here, or an S&P 500 ETF index fund. These are just things where it's a collection of stocks. So like the S&P 500 means you're getting 500 companies in one basket pretty much. So when you put, let's say you put um $100 in there, right? Let's say you start with $100. Well, it's weighted differently. So like Nvidia, Apple, Google, certain companies are going to have a bigger percentage of that index fund. So like I think Nvidia is the biggest. They have like 6% or 7%. It's weighted by market cap. So the bigger the company is, the larger percentage of your money that's going to go into that stock. But those are some of the safest things you can do. So the first thing I want to pull up here is the last. This will give you an idea of how much money you're going to make, how risky it is, and how much you can lose. Okay. This is the last almost 100 years. This goes back to 1929. Okay. So all the years that are green are positive returns. Okay. So here's all the different years all the percentages you would make. The late 90s, early 2000s was good up until the 2000 and 2002, right? But a lot of these years, I mean, in general, you're making, let's say, 10%. Normally it's like 10, 12% in the S&P, and then it's like 15% in the Nasdaq, just because it's a little bit more volatile, meaning the ups move up a little bit more and the downs you go down a little bit more. So if you want to be extra conservative, then you go in the S&P 500. It's more diversified, and it's less, I don't want to say less risky, but it's less volatile. It's not going to move as much as the Nasdaq. I prefer investing most of my money into the QQQ or the Nasdaq, because this index fund, like I said, it's more volatile, but you're going to make more. So look at the last 5 years for the QQQ is up 106%. What is the S&P up the last 5 years? I actually think right now it's close. It's 88%. So yeah, again, the QQQ, you make a little bit more. Um, so just keep that in mind. But back to this chart. As you can see, about 80% of the time, you are making money. The market is going up, right? So you're going to have the years like this where the market crashes, right? So the worst of the worst was like, the Great Depression down 47%, and then the financial crisis of 2008 down 38%. Those are extreme years. And as you can see, over the last 20 years, we really haven't had anything as bad as, we since 2008, we haven't had anything nearly that bad. The last big one was 2022. The market dropped 19%. So that gives you an idea of how much money you might lose if you're in the market. And they say don't try to time the market, which there is absolutely some truth to that. But you can also look at it like when the market's super hot and everybody's bought into it and it's hyped up and it's been going up for 5 years, it tends to be a little bit overvalued. That tends to be the time where it's better to take profits, because the crash or a correction is most likely coming pretty soon. So as you can see, I mean, normally before a big drop, you have multiple years of big green returns here. So not only is 75% of the time, 80% of the time you're making money, 75% of the years is going to be a positive year. But look at how much you're going to make on some of those years, you're going to make 34% in a year, right? And I don't know. You can make a lot of money most of the time. You're going to have a positive return. You're going every now and then there's going to be a negative year, but you're going to make way more for the when in the years following. So just keep that in mind. This is, the best investor of all time is Warren Buffett. This is the strategy he used. He, bought when stocks go down, and that is the time when you have to look at this game like you're buying and selling, right? You're pretty much flipping stuff. You don't want to have a short-term mindset. Keep in mind the taxes you pay are a lot less if you hold your stock for over a year. So definitely keep that in mind. If you trade buy and sell your stock in under a year, well then it's taxed as normal income. So well, and although that's true, I want to say up to $48,000 of profit. I want to say it's 0% taxes. I'm not sure if that's short term or long term, but up to $48,000 of profit from stocks can be 0% taxed. So just keep that in mind. And I mean, long term capital gains tax on your stocks is only going to be like 15%. So keep that stuff in mind. Then this is another type of chart I would use. This is on yardiniresearch.com or yardini.com. But this research pretty much shows the PE ratio, which stands for price to earnings. Just think of it as like the price. It pretty much means, let's say for the last 25 years, if a company earns $1, how much are you paying for that? That's basically just think of it like that. That's what this chart shows. So for companies that earn $1, let's say for every dollar a company earns, this is how many times that you're going to pay. Pretty much that's what the company is worth. That's what you're buying the company at that price. So if the company makes $1 million and it's trading at 20 times earnings, a PE of 20, you're gonna buy you're paying $20 million for a company that makes $1 million. That's the way you look at that. Okay, so as you might imagine, when things are really hyped up or the market keeps going up, people are putting money more and more into stocks and it keeps pushing the valuations up. Well, those valuations get higher, right? So as you can see, like right now, it's relatively high. It's relatively high for the last, especially for, the last 20 to 30 years, but even as you can see past like 2020, we've been in a different type of market where, especially for these large cap stocks, look at the red line is the large cap stocks. Look at how much higher it is than where it was at any point between 2000 and 2020. For this whole 20-year span, it was mostly at like a 15, right? It was trading at a 14, 13. Now, the last 6 years, we've been in a different kind of game where it's more at like a 16 to a 23. That's kind of the new thing we've been in the last 6 years. So who knows if it's gonna go back down to whatever number, but we're almost in, I don't want to say an all-time high, but I mean, look at, you go back to even the 2000 bubble, that was the dot-com bubble. That's pretty close to what we're at right now. And remember, the last crash was 2022. That's this big drop you see here. Before then, the valuations were pretty close to where they were back then when it was about 22 times earnings, which makes me think we're probably going to have a correction coming up soon here in the next 6 months or so. But this would just be an example. I mean, there's a bunch of charts in here, but this would be a way to analyze and measure, assess what sort of price you're paying, risk you're taking on, things like that. Now, especially as a beginner, I would just buy the index funds like VOO, QQQ, SPY. Those are typically the safest things you could possibly put your money in. If you're going to buy individual stocks, you're buying individual shares of companies like Apple, Google, Microsoft, Amazon, Netflix, whatever you want to buy, that is a possibility, but it definitely is more risky. It will be more volatile, and with individual, when you do that, you're going to have periods where one of those stocks might go down for a year. It could go down for a year, right? If you buy it at the top, it might take a year or two to get your money back. Now, you go look at most of these, most of those big companies, you're going to make a lot of money. You look at Google in the past year, it's up 88%. And if you would have bought anywhere down here, you would have more than doubled your money in under a year. Just think about that. In less than a year, you would have doubled your money on Google, one of the biggest, most famous companies in the world. It's not like this is some penny stock. Speaking of penny stocks, that's I would stay away from those as much as you possibly can. Um, that's just typically the smaller the company is. The penny stocks and those small, super small growth companies that get hyped up. That's what you want to stay away from. I would say safest, best thing you could start off with is an index fund like the ones I listed. Then, if you maybe wanted to put a little bit of money into these certain stocks like Google, Amazon, Apple, whatever you like, um, that's not a bad idea either. But again, just try to buy. Like right now, I would not buy Google. Google is probably going to go down because again, you look at the PE ratio, go look at the valuations. Um, but generally, see, look at this chart. Google's been almost up in a straight line. That means it's due for a pullback at some point. And then if it flatlines like this, see how it's kind of been flat for multiple months. That's where okay, now especially if the company's numbers have grown, like the net income and revenue has grown during that time, then that's a good time to buy. Okay. That's kind of the way to look at that. There's a bunch of websites you can use. Yahoo Finance is a great one. I use this for a lot of stuff. You can look at the charts. You can look at, you go to statistics here, shows you the main ones you want to pay attention to are trailing PE and forward PE. Trailing PE is like I was saying, the price you're paying for the trailing 12 would be the trailing 12 months earnings. That's trailing PE. Forward PE means the price you're paying for the expected earnings over the next 12 months. So keep in mind, expected. It can vary. They could either miss those numbers or beat on those numbers. But it's what analysts kind of are expecting them to do for EPS or net income for earnings, basically. So, like, look at here's Google. Right now, it's trading at 29 forward PE. Typically, it's been a 19, a 21, a 17. It's been a lot lower. So right now, investors have really piled into the stock, probably because they're hyped up, excited about the AI. Almost pretty much every time the valuation comes pretty close to where its median or average is. So just keep that in mind. That's a basic thing of what you want to look for. It's the same thing. Price to sales is the same idea. For me, I think the forward PE is probably the number one most important thing. Come over here to analysis, and then it shows you again. Here's the EPS. EPS stands for earnings per share. Year ago, EPS was $8. Average estimate, and keep in mind, number of analysts. They have 53 analysts that are coming up with these numbers, right? Average estimate is $10.52. Next year, it's 11.14. So that gives you an idea of what they're going to do and how much they're going to grow. Same thing here for revenue. We're looking at sales growth. This year expected to be about 14%. Next year, about 13%. Those are just a couple things to keep in mind. I use this platform called Qualtrim. I subscribe to um, Joseph Carlson's Patreon. You get access to his software here. I think this is probably my favorite software. It just shows everything that you need. It has all this different stuff here. Um, and again, I would say forward PE is a really important one. And then I look at like net income and free cash flow. So that is probably, oh, I guess I could rewind a little bit and say I use the platforms Robinhood and Fidelity to trade. But you can use so many different sites. I mean, I would say if I were to pick up like the most trusted one, I would say Fidelity is probably up there. But if I were to say which one do I like using the best and has the best interface platform, I would say Robinhood. Robinhood is super fun to use. It's super easy to scroll through stuff and look through stuff. Fidelity is a little bit harder. It's just not as fun to use. But basically, you make an account with any of these different brokerages, and you can start with however much money you want. Even if my first trade 9 years ago was for like $25. Okay, so I think that's all the main points. If you have questions or something, just comment down below or contact me. And then to end this off, I want to go through 5 stats that I asked ChatGPT for, just to give you another idea of how the market behaves. So, average bull market length lasts about 4 to 5 years on average. Okay, so keep that in mind. That's before you have like a correction or something. A lot of times, the average bull market will last 4 to 5 years. They end when valuations stretch too far or the Fed tightens aggressively. Okay, that means what they do with interest rates. Then the typical bear market falls 35% from peak to bottom. That's kind of like what I showed you here, although that sounds a little bit too extreme. 35% is kind of rare. Maybe for huge recessions or huge crashes, that's about what it could be. But as you can see, a lot of time you're going to get ones that only are like 20%, sometimes even 5 or 10%. So it all varies. But just be, um, ready for those things to happen. The other thing is like, let's say a year like 2005 or 2007, I'm not 100% sure what the market did that year, but it says it was up 3%, right? But what that it doesn't tell you, the market could have corrected that year and dipped down 15%, okay, which is a decent amount. It could have fell 15% and then jumped back up at the end of the year, and it came out positive for a year total. So keep that in mind too. Those things can also happen. Then we have historically the S&P 500 is up about 54% of the days and down 46%. Okay, that sounds about right. I guess that's right, but keep in mind, I mean, the up days are typically a lot more than the down days. That's why you see here it's like 75% of these years are positive years. Big gains cluster in just a few days, which is why timing the market fails. Yeah, and that's a big deal. That's a big one that you're not supposed to time the market and wait for stocks to fall. You're not supposed to do that. So we could that's for another video. I have other videos on that. Recessions hit roughly every 7 to 10 years, and yeah, that's important. That's not the same thing as a crash, though. Corrections or crashes happen more often. Markets usually bottom before the recession. Investors price in the recovery. Okay, and then when the S&P moves to a 25 to 30 PE, futures tend to be weak. And when it drops below a 15, the 10-year returns tend to be strong. So I think I hit everything there. Again, if you have questions, just contact me or comment down below. Thank you for watching, and I will see you in the next video.